So, thank you for joining, as I said, the third webinar we're having in the FIND project. Carolina, maybe you could take us to the next slide where I can show the agenda of today. So first I'm going to welcome you, which I've already done, and tell you shortly then about the FIND project, what we're trying to achieve. Then we will have two very interesting speakers, starting with Anton Arts from Set Ventures. I believe you're the largest VC in green fintech in Europe. And then Ian Ormerod from Switch to Zero, a new fintech startup of the UK, but we are counting you as Europe anyway. So they will tell us some more about what's actually happening in the fintech and sustainability market. And after that, I will shortly show you some of the tools that we have developed in the FIND project that you can maybe use and that can help you to see more, find out more about investing into fintech and joining up with other investors or fintech prospects that you would like to invest in. All right, so then we'll go to the next slide and I will tell you a little bit about the FIND project. The FIND project is funded by the EU, and its idea is to connect the European fintech networks. And we're trying to realize this interconnection of the fintech networks through the collaboration of investors. So the idea is that investors internationally reach out to invest in another country and they invest together, because the local investor knows more about the markets, but sometimes, especially for regions in Eastern Europe, there could be more investments or investment money that is not available in the local market. So that's the idea. So we want to increase the access to capital and investments for lesser connected fintech innovation regions. That's the whole idea. We have on the next sheet, you can see slide. If you could show us the next one, Carolina, you can see the objectives. So we want to increase the access to capital for the less connected fintech regions. We want to increase the access for investors to the flow of local deals. We want to improve the accessibility of the knowledge about investments. And there are some tools that have been developed for that. We want to connect the networks, as I have already said, and we want to facilitate inclusiveness and gender equality. So there's extra attention for women investors, migrant investors, and new investors into the ecosystem. So that's what we're trying to do. The rest of the sheets that I have, I will show you at the end. So maybe, Carolina, we can switch to the first sheet of Anton. Anton, I will gladly give you the floor to tell us a bit about yourself, of course, and about your very interesting company and the fintech market.
Good afternoon, and welcome to this webinar. My name is Anton Arts, and I'm a managing partner at Set Ventures. Set is one of the oldest venture capital firms that has been active at the intersection of innovation and sustainability. SET, in fact, stands for Sustainable Energy Technologies. We've been around since 2007, investing in European entrepreneurs that develop technologies that advance the energy transition. Next slide, please. So I see the formatting of this slide has suffered a little bit from transferring to the FIND system, but we'll deal with that. So let me tell you a little bit about SET. Our vision is that the energy system of the future will be defined by digital technology. And why is that? We believe that the future is a dynamic energy system that manages how renewable generation and the usage of energy is all combined. We believe that digital technology enables and sustain this, and have been active in each of these domains, building a portfolio of, at this time, about 20 companies that are market leaders in each of their fields. So, next slide, please. Today, what I'd like to do is share some work that we have done to look closely at the intersection between our market, which is energy tech, and fintech. And we have translated that into what we call a market map, which is basically a segmentation of different companies and business models that we have seen. This is a big part of how we like to find interesting investments, rather than waiting for stuff to come in. We have a thesis first model whereby we're basically looking at interesting subsectors and spend a considerable amount of time in a research phase trying to map out the ecosystem, the value chain, and benchmark different companies that we see across Europe. So on the next slide, let's start with what is the reason there is an intersection between energy tech and fintech in the first place. So if you try to zoom out from all the things that are happening in our market, one very big, very important phenomenon is that we're moving from a world in which energy is delivered from centralized systems through the grid to your business or to your home, essentially as kilowatt hours on tap, as much as you want, when you want it, when you need it. And we're replacing that by a much more dynamic and flexible and heterogeneous system in which a decentralized energy system of the future will consist of many different components that are either co-located with the user, or they can be co-located at an industrial park scale, at a city scale, at a country scale. And all of these systems are also becoming a lot more varied. Instead of paying every month for a certain amount of power, maybe I have my rooftop solar system, I have my battery, I'm consuming energy through a heat pump instead of a gas boiler, and my home is becoming an energy home. It could well lead to a situation in which I am on a net annual basis producing power rather than consuming it. Sorry, could you go back? And so a really important step forward in this energy transition is that rather than paying as you go every year, consumers and businesses have to start investing in order to realize the gains from this energy transition. On the next slide, which leads to the observation that access to financing is a major hurdle for this energy transition, because even though users are eager to adopt these solutions, are eager to make their home green or net zero or sustainable, they may not have the capital to invest. And what is very exciting about this is that as this renewable hardware becomes cheaper, the actual return on investment of these systems goes up considerably. However, vendors, who would be the first point of call for people to offer finance solutions, may not always have access to that financing in order to increase their market share and make it easy for consumers and businesses to buy these systems. So on the right-hand side, there is an example of some research done by BNP Paribas that looked into these hurdles for the adoption of renewable systems. And you will see that price is a major factor. But then there are many factors that have to do with, what am I buying? How am I buying it? How am I financing it? And at this point, it becomes quite difficult and complex for average consumers to step into that world. On the next slide. So we see this as a really interesting opportunity where financial and energy companies could collaborate. So what's the challenge? If I'm a consumer and I have a big ticket investment to make, obviously I can go to my bank and I can try to borrow the money that I need in order to buy a solar system or a battery, a heat pump. But if you look at the problem from the providers of these loans, even though they would like to engage in this kind of lending, their traditional underwriting and consumer finance channels are not really aligned with it. They cannot differentiate between you borrowing money in order to get a new kitchen or to upgrade your house to make it net zero. And that is obviously a huge difference in terms of risk profile. And so we find that the traditional channels and the traditional parties that provide this type of financing tend to overprice that risk, tend to not be able to account, for instance, for the fact that if you invest in an energy efficient home, your net disposable income goes up. It's not an expenditure, it's actually an investment. The second factor on the challenging side is that we see a large amount of institutional investors that are actually looking for green investments, but they don't have the distribution and brand to do that directly themselves. They cannot deploy the capital at the ticket size that users need it, and they don't have the brand in order to operate in this market. So what do we see as solutions? And we'll talk about that a little bit more in the context of the market map. So first of all, we see a real opportunity for specialized underwriting based on data. Data about the assets, data about the utilization. And that translates into uniform risk pools that are very, very attractive for institutional capital. And so there is a real opportunity for Fintech startups that can connect the supply and demand of capital. The second factor in this equation is how we leverage impact. Because the demand for sustainable loans is based on the EU regulatory framework, the SFDR. And so for those providers that are able to have very fine-grained, data-driven insights on what the financing is used for and how it contributes to an impactful future, that makes the sourcing side of that capital a lot more attractive. Thirdly, it's all about efficient channels. How do you get to the client? And we see a couple of different models here. So one example is what we call energy as a service. And these are essentially vendors that offer energy solutions, for instance, home solar, home batteries, business energy systems. There is a wide variety of these providers. And they will look at financing as one of the ways to to make their offerings more attractive and more easy to buy. The second category are those vendors who are strictly focusing on providing the financing. So they will let the products and services supply to others, but they will concentrate on just providing finance. And we're seeing that in a number of markets, there are large companies who are really scaling at a rapid pace in this domain. So on the next slide. So how does this look if you try to zoom out across the market? Next slide. We're super excited about seeing this phenomenon really take off in Europe. The graph on the left looks at fintech funding in energy and sustainability and identifies energy as one of the most significant categories in that whole domain. On the right-hand side, we're also seeing that this phenomenon is playing out much stronger in Europe than either in the US or in Asia. And we think that puts Europe on a very good foundation in order to bring together the dynamics of these two ecosystems in order to propel the energy transition forward. So next slide. So how are we looking at this as an investor? And for context, we are an investor who looks at providing early stage Series A capital to companies that have established themselves in the market and looking for capital to expand their business and to scale. So essentially segmenting the market between 3 different business models and 4 different markets. So as I said, from the right, integrated energy solutions are companies that are essentially trying to offer energy systems, services, and financing all as an integrated offering to clients. So financing is if you will, integrated in the offering, and for customers, this goes back to paying on a monthly or yearly basis for the systems you acquire. And so it also leads to a very direct cost savings without asking the customer to come up with the capital in order to put up the systems. So that is a very powerful business model. And we see this play out across many different markets, both geographically as well as whether we're talking about solar, batteries, heat pumps, etc. In the second category, we see the vendors that are focused at providing just finance. And of course, what makes that attractive is that they're not depending on building up their own distribution of energy offerings, and they can work together with a broad range of vendors in order to make those offerings more attractive. And finally, we see that crowdfunding is playing an important role in this market, and that there are a number of vendors who are focused at organizing themselves in order to channel money from crowdfunding sources to different applications in the energy system. And we look at multiple levels. So first of all, residential, which in this chart you can see is one of the most attractive and active markets in this space. But secondly, more complicated, bigger, is the market segment of decarbonizing commercial and industrial energy consumption. And here we see some of the most exciting developments in the market, really looking at making individual companies or entire industrial estates operate on a far more green basis. Another area where we've seen a lot of activity is on the deployment of especially batteries across our energy system. and how to organize the capital flows in order to support that. And finally, we see a number of companies that are active in fleet electrification and EVs, where companies not only have to invest in the cars, but of course also in the charging ecosystems and infrastructure in order to make that happen. Well, let me stop here for a moment and give the audience a chance to ask any questions they may have about how we're looking at this market and why we're excited about the intersection between energy and finance.
Thank you, Anton. As I've just put into the chat, if anybody has a question, you can, oh, sorry, so you can all see me, yeah. So you can either use the chat or use the Q&A option. And there is already one question from Lisa. How would you advise an investor to find the right fintech to realize his or her investment goals? Is a question.
I would advise to look at a couple of different aspects. So first of all, the question is, are you looking to invest in the company that organizes this activity, or are you more interested in providing the financing for the actual assets? And it's good to separate those two categories, because of course, investing in these companies has a higher risk profile than investing in the underlying assets. And so we would see the opportunity for infrastructure financing as having far less risk than the companies that are innovating in this whole category. Secondly, the question is, are you more interested in the decarbonization of homes, or are you taking a broader look across the entire economy? And the third question is, what is the company that you plan to invest in? What are they bringing? Do they focus, for instance, on very close connections with customers in a particular ecosystem? Can they provide a sustainable advantage in cost of customer acquisition and access to channels? Or are you more looking at a company that is good at sourcing capital and that can have a competitive advantage on that side? And so those would be some of the factors that we're trying to understand in our deal sourcing, looking for companies that where we believe most opportunity is actually on the customer-facing side, and in terms of the level of integration between different energy assets that you can offer. Does that answer your question? Any other questions, or should I give it back to you, Georgie?
Yeah, I think, no, she said yes. Thank you. That answers her question. And yeah, she was interested in the broader look, which you were talking about. So not just the targeted area of the homes, but the broader look, like you said in your presentation. All right. Thank you very much, Anton, for now. So that means that we can now go on to Ian's presentation. So, which is a completely different company from Anton, although there are links, because as you saw in Anton's presentation, a lot of companies are interested in sustainability. A lot of investors are looking to add sustainable investments to their portfolios. And of course, an interesting question then is, how do you know if your investment is a sustainable one or not, and in what matter or how sustainable it is. So talking about this, I would gladly give the floor to Ian. Ian, please start with introducing yourself and your company to us, because I think you're a very interesting fintech startup. And yes, I give you the floor.
Great, thanks ever so much, Georgie, and Georgie, and thank you everyone for joining this afternoon. I'll start by giving a tiny bit of background on me. So, because it will give context what I then go on to talk about. My background's actually in banking. I've spent 27 years working for some of the biggest banks across the globe. Most latterly, for BBVA, where I ran what they call digital new business, which was effectively building out, investing in and buying new fintech businesses on their behalf. So I suppose I've come very much from the fintech end and the financial end. I then left the world of banking just before lockdown and COVID, because I had become more and more interested in the sustainability space, developed a few models for BBVA. It's something they're very, very passionate about as an organization, and decided that I wanted to go and focus more of my energies on the green side rather than the fin and side of activity that I'd traditionally done. So if we could just jump onto the next slide, that'd be great, please. To give you a tiny bit of background on Switch to Zero, we were incorporated in November 21. We're here and our mission is to help accelerate the global transition to net zero. To do that, we focus on 4 primary areas: helping people understand what their footprint is, so the component part of it, the calculation of a footprint, giving and enabling both reduction advice and reduction activity, and should they wish, helping to offset any residual footprint that may be there, as well as helping them report on their progress and track their progress, whether that's from a regulatory perspective or connected to procurement deals or other things they may be doing. And I suppose connected to that, we produce a lot of marketing collateral to help them showcase the journey they're on to their own customers or target audiences, so that they can both celebrate what they're doing, but drive more top-line business as a result of the activity they're doing and stand out as a bit of a differentiator, being a more sustainable business. In terms of what we've been up to, we are principally a B2B business, so we target other businesses. However, the way in which we build our solutions and products is we build core capabilities and we put product wrappers around those. So whenever we're launching a B2B product or solution, we are typically in parallel delivering a B2C capability at the same time, because it's just a slightly different product wrapper. Therefore, we do have a fair few B2C customers, but we don't actively hunt in that space, but we provide solutions because we can. And it's at no cost really to us. We have about 1,500, more than that now, since these slides were done, clients spread across about 11 countries, more than that now, actually 13, 7 of which are countries in Europe outside of the UK. And we have some global partnerships with a lot of our offset providers, whether that be the United Nations, Gold Standard, and a few others that you can see on this slide. If you wouldn't mind jumping to the next slide, that'd be great. Thanks. So the way I thought I would talk about this is almost break down the word green fintech and talk about those sort of areas and try and bring it together a bit by bringing to life some of the things that we do and why. And I think the first one I wanted to start with was the green element. So when we talk about green, what is green? And I think the most straightforward way of categorizing this, because ultimately this is where the use cases that any business is working on has to talk back to be credible, is the greenhouse gas protocol. I'm sure a lot of people are familiar with it. But effectively, the greenhouse gas protocol, for those that aren't, is the standard framework that's internationally recognized that anybody that is calculating a footprint, any business that is, are doing it against the GHG protocol. What the protocol does is chop up the footprint into 22 different categories that you can see on the slide, and then subdivides those again into what it calls 3 different scopes, which again you can see on the slide with the 3 different sort of base colors of scope 1, scope 2, and scope 3. Now, the reason I mentioned this principally on this to start with is when we're talking about green and you're building a use case, I think from a credibility perspective, it needs to talk directly back to something in these areas. And if it's not, then arguably it's not green. It might be partially green, but it's not fully green. In terms of activity and things that you can look at, the way that we typically talk to a lot of our clients about this area is when you look at the footprint of a business, you can chop it up into scopes and categories, as you'll see in the boxes below. But equally, when you look at yourself as a business, there are elements of a footprint that you create and own. The carbon footprint, I mean, obviously. And then there are elements of a footprint that are created as a result of what you do, but are often owned by or created or generated by somebody else. And that's either upstream, so in other words, before anything gets to you, or downstream, so after you release your products and solutions. And I mention this because the vast majority of use cases are sat within what is called scope 3, which is equally sat largely upstream or downstream of whatever your core business operations are. And just to bring that to life with a quick example, if you brew beer, then you have a number of upstream footprint things. So you'll purchase barley and hops or whatever it may be from producers, from farmers. You're unlikely to own those. All of the footprint associated with the growing of those crops to the delivery to your door technically sit within your scope 3. But obviously they are also typically the scope 1 and 2 footprint of that farmer or of that distributor that delivered the product to your factory or your brewery. You then do a lot of things with that hops and everything else and create your product, consuming your own energy to do that. You purchase kit that enables you to do that. The kit you purchase, so the capital goods that you're investing in that enable that, the big sort of hoppers or whatever that you're using from a brewery point of view, they're purchased from another supplier. That supplier has their own footprint, the embedded footprint of that product that you've just bought. You then do all your stuff. Your principal footprint, your scope 1 and 2 footprint, is really about the energy you're consuming to do what you do, whether that's electricity in scope 2 or other forms of combustion in scope 1. There are a number of scope 3 areas that are still completely controlled by you. A good example of that being waste or business travel. So nobody else is responsible or influencing those things. And then there's the downstream footprint of what you do as a business. And so once your product is sold, what does the usage of that product consume in energy? But equally in financial services, it's massive. So of the investment, if you're lending money as a business, what is that money then generating as a footprint as a result of what is acquired by it and how that thing is used? So the reason I wanted to push this up first is when we talk about green, ultimately, I suppose the message is you need to get back to one of these things. And from a fintech perspective, there are a number of areas that I believe are great places to start. And I've highlighted those in red. I'm not going to go through them all individually because we won't have the time. But to give you an idea of the scale of the market, and the scale of across scope 1, 2, and 3. If you look at the financial services sector, 99.98% of its footprint is in scope 3. So that gives you an idea of the scale of things sat out of the direct control of a business. Now that's good because it means they've got a problem that they need to fix because they don't have direct control over, which means there are a lot of use cases and a lot of problems to go after. So from a green fintech perspective, there's a great landscape there to go after. The second thing I'd say in terms of the size of the market is it's estimated that by 2030, this is a McKinsey report, but by 2030, the annual spend on transition is going to be about 9.2 trillion, or needs to be if we're going to get anywhere close to the Paris Agreement commitments. What does that mean when you really, really break it down? It's to remove every ton requires a capital investment of around $6,800 if you do the maths and sort of run it through in terms of global footprint and things like that. So there is an awful lot of money being spent on changing infrastructure and products and solutions to reduce that consumption and that footprint. And from a fin perspective of the fintech, that means there is a massive opportunity to take control of that flow of money and data and solutions to enable that transition. Which I suppose brings me on to the next section, which is the fin and the tech area. And I'll come on to this in a little bit more detail in a minute. But when you think about the fin and the tech side of green fintech, when you're labeling fin, for me, really all you're talking about there is how do you borrow, how do you move, how do you invest, how do you protect, and how do you store money? Those are the fin things of green fintech. And then from a tech perspective, I think there's some interesting things happening there. We're kind of going full circle, I think, and technology is enabling us to do that. So initially, if you wanted to do something as a human being that you didn't know how to do yourself, you would go to a do-it-for-you solution, which was typically another human being. You know, in the olden days of banking, if you wanted to get a loan or you wanted to do something else, you'd be rocking up a bricks and mortar branch, you'd be talking to a branch manager, you'd be getting a loan. The first wave of sort of tech made that very much DIY. Everything started to become available on apps. There were decision making. The processes were simplified. They were made easier to understand. The human, from the advisory perspective, it was taken out of that equation to a degree progressively, and you could do it through the glass. You could do it yourself via touch. What technology is now bringing is a do-it-for-you capability to the DIY, which often wasn't there from the original tech solutions. So if you happen to know how to do those things and could tap the glass in the right way, you could get your personal loans, you could get certain things from a finance perspective. But if you required expertise or additional knowledge, that was often absent. Obviously, with the massive progression of AI capabilities in various different areas, those recommendations engines have become much more sophisticated. You've got obviously large language models now coming in, making the next sort of wave of disruption in the space. So when we talk about fintech, we've already covered the green, obviously, with the different categories that we're talking about. Sorry, if you'd like to move on to the next slide, that'd be helpful. You then start to think about, right, okay, it's about how we borrow, move, invest, protect, and store money in as close to a do-it-for-you perspective as possible. And that's combining advice and data with the use case solution itself. This is a categorization of fintech, which is the best one I've seen. There are a fair few out there, but it was a collaboration between the Green Digital Finance Alliance and the Swiss Green FinTech Network. And really what they were looking at was, if you look across the market of green fintech, how could you categorize it so that you can start to chop it up and think about the individual use cases and approaches? I know we're sending these slides out and this is recorded as well, so I'm not going to go through this in loads of detail. There's also a link at the bottom to the full paper, and if you have time, I'd strongly recommend you read it because it gives a really good overview of the fintech sort of ecosystem and the green fintech ecosystem and marketplace. But just at a high level, you know, I've mentioned sort of borrowing money, moving money, investing money, protecting it, and storing it. The main areas that I think personally are the growth areas from a green fintech perspective in terms of scale and size are certainly in borrow money. And Anton spoke very much to that when in terms of some of the models that are being developed for the purchase of big capital goods, whether that's solar panels, heat pumps, etc. And I think personally that's number 6 on here. But I think the big challenge there is answering problems at both ends. So from a consumer perspective, whether you be a business or you're or an individual, so the person buying that capital good, you've got to make the money equation work. So if by purchasing this solar panel, is there a model that means my disposable income or is increased as a result of it? Exactly what Anton was saying. And does that work for the longevity of whatever commitment I've just taken out? Equally, if you're thinking about it in the context of a footprint, and which is very much often in the business scenario, and it's a conversation we have models we work with a lot of businesses we talk to, is you take solar power as an example, you may choose to put loads of solar panels all over your roof. But actually, if the national grid you happen to be operating in is a long way through a transition to renewable energy, and you can pull from the grid renewable energy anyway, then there needs to be a really strong, compelling argument from a cost reduction perspective or a resiliency perspective that would make sense for you commercially. And you've really got to get into the weeds to understand that side of things. Then at the supply side, so if you look at the bank sat there with lots of money and lots of public promises to issue green finance and all the other finance options available, but you take BBVA as an example, they've made a very public commitment to lend over 300 billion of green finance by 2030. But the challenge they have, along with a lot of the banks, is really twofold: the risk modeling that Anton was talking to earlier, but equally just the access to that market in a way that makes sense at scale, because they can do big corporate bond loans, but chopping that up and trying to create green loans for solar panels or for other things, really what you've seen in this first phase is them effectively just labeling what was a personal loan a green loan because it happens to be attached to something that is electric vehicle or solar panels or whatever it might be. They're not really doing anything much more sophisticated for that. And there's 2 reasons for that. One is the actual distribution, the complexity associated with that. And the other is actually when you look at the risk modeling of these loans, there are some big positives associated with lending money for green things, particularly in the consumer space. One of those being, for example, it is likely that the people or data will show you that people purchasing solar panels, heat pumps, and other things tend to be at the lower risk end of investment, as in, frankly, they're wealthier, they're a better credit risk. And so that's one sort of good reason for going in that direction. But there's some counterweights there that also make it quite difficult. If you're lending money on things like solar panels and heat pumps that are effectively attached to a property, bearing in mind there's no real reliable secondary market for these things, if someone stops paying that loan or moves house or what have you, then there are challenges from a default and a debt recovery perspective that aren't necessarily there with some other big capital purchases. And so the modeling associated with that is something that is getting smarter over time, and you're seeing some fintechs coming in to try and help that space. But I think that's a big sort of challenge to some of the areas we're seeing, or I'm certainly seeing from a fintech perspective. And that's part of the pitch that we're starting to, in the conversations that we're having with banks, is can we provide the intelligence layer that works in both directions, helps them underwrite and create models for financing and enable that at a scale and a premium level that make sense both for them and the receiver of those funds. But then secondly, and this is a big win for banks, is can we create the data flow backwards that tells them exactly what their savings are going to be from a CO2 reduction perspective as a result of that investment. So those are areas that we're certainly looking at very closely and starting to develop products and solutions for. But I suppose just before I move off this slide and move on to the next one, there are a lot of very interesting areas that you can also go into, whether that is using distributed ledger technology to start to track provenance of carbon offsets and things as an example, or whether it's Internet of Things and tracking green solutions in real time to see what energy provision they're giving or not giving and the efficiency associated with it. There's loads of other very, very exciting areas that open up great use cases that I think can be gone after. And there's some great companies already doing some really impressive things in that space. If we can move on to the last slide, please. So I'll be relatively brief, but I wanted to talk to you a little bit about how we're thinking about this space and where most of our activity is currently and where it's going. So we've developed a fair bit of capability on our platform that enables businesses particularly, but also individuals to calculate their footprint and take them on a journey for forever increasing granularity. So because to do stuff to reduce your footprint, you don't necessarily need to know what the exact number is, but you need to know what the contributing components are so that you can start to address those. So the journey we take our customers on typically is a very high level market sector benchmark of what their footprint is, some high level advice about the primary components that are driving that footprint, and access to further advice and potentially solutions that can help them reduce that over time. That also sort of ticks boxes for regulatory. The high level estimate doesn't, but should they then want to get into more granular calculations and everything else, we have a consulting solution that enables them to calculate a verified carbon footprint, things like that. We have various different offset solutions that enable businesses to offset their known footprint. Some of that is pay-as-you-go, some of that is SaaS-based, some of that is an API integration so that you can plant trees with each purchase if you're an e-commerce provider, for example. So that some of that is very much footprint related. So it's about purchasing voluntary carbon offsets. Some of it is more about positive sustainability action, like planting trees and funding the collection of plastic waste. In terms of where we're going is, now that we've built out and have so much data around the cause of a lot of the footprints of a lot of our customers, and we know they're on a journey to want to reduce it, and we're recommending the elements that they need to do, what we'll shortly, and what we're doing in the background, although we haven't released some of this yet, is we're building out both the marketplace and associated finance for those solutions. So effectively, what a business will be able to do when they come to us is calculate what the footprint is, get advice about how to reduce that, and also access to a green reduction fund that they can draw down on as they acquire or purchase or execute activity that enables them to reduce that footprint. And in return, we're flowing data back to whoever those finance providers are about the impact of their investment on the reduction of those footprints and the activity. On top of that, we are also exploring models that Anton has already mentioned, which is really flipping the model on its head so that you don't have to take out a massive capital or make a massive capital investment in order to purchase solar panels or other energy efficient mechanisms. Instead, you're paying for the consumption. So you're turning what is a traditional loan model into a SaaS model for effectively a pay-as-you-go model for your consumption of the benefit coming from those solar panels or heat pumps, rather than anything else. And we would take on that risk with the financer in terms of the ownership of that hardware, the maintenance of it, and it's the consumer that then pays for the consumption of it.
But
So,
Ian,
Yeah.
I have a question here.
Yeah.
If so, you help firms to show and offset their footprint. Is that through a consultancy or through a subscription? How does it work?
Yeah, so we have multiple models, and it really depends on the level of granularity and of requirement for the business themselves. If they're looking for a formalized, verified footprint, then that does require a consulting element. We are developing in the background more self-drive tools, but ultimately what we find is it's a combination of both. We're giving them tools that they can self-input and use, but they still requiring a fair bit of advice to help navigate all the categories and things associated with that. So there's kind of a hybrid consulting model.
Right.
But at the easiest end, we also have a completely self-drive sort of benchmarking tool where they don't need consulting.
Okay.
For both of those, there's a SaaS model in terms of paying a monthly fee, but obviously there's a big variance depending on how much consulting there is as a result of it.
Okay, thank you. So we're running out of time a little bit. So I was wondering, would you want to, can you round it off so I can give the floor to...
Yeah, well, that was really, sorry, that was it. I'd kind of come to a natural end, really, which is,
All right.
that's what we do. Hopefully that gives you a bit of a flavor for what we're doing in the landscape that we're trying to do it and where we're going with it from what we're learning, but very much open to questions or anything now. That was definitely it for me. Thanks.
All right. Thank you so much. So is there anybody else who would like to have a question? Are there questions from people? Because if not, then we have another very interesting speaker with us. Oh no, he's left. That's a pity. But if there's not any other questions, I would like to shortly take you through the fine tools that we have developed. Carolina, if you could take us back, yes, to that sheet, that was the objective. Yes, what we've done in Fine, we've built a community. So all these questions about what Ian and Anton are speaking about, which of course is, you know, it's high tech, it's very high knowledge levels. I mean, to invest into a company, if a company like Anton is has described, is very hard. You need a lot of knowledge, I think. So the Fine project is trying to bring people together. It's trying to match the investors and the fintech companies. So we have a matchmaking network that you could join, which matches investors to each other, but also to fintech prospects, like Ian's, because Ian, you are also actually a developed fintech in a way, or at least a green company. So you could definitely be one we could be matched to. And on the next slide, you can see that we also are building a community. We have a Slack channel, an active Slack channel that you can join. There's a lot of news there, a lot of information comes across about events, etc., etc. And on the next slide, you can also see we have an ambassadors network. We have 18 experts who can help you, connect you to investors, and give you a lot of information that they have, a lot of their experience. And we also have an investor academy and an ecosystem map. So the ecosystem map gives you a broad overview of the fintech landscape in Europe and all the specifics of the different countries. And the Fine Investor Academy gives you some courses and information if you want to learn more about the fintech world in Europe. And I also think we have, did we make a connection to this is an example of the investor map, where you can see the countries that have been described in there. And do we also have the link to the Slack channel? Yes, if you want to join our Fine network, here you can see the QR code. So please join us, because we need all of you to make this a strong and useful network. I think Anton and Ian's stories are complements, right? I think Ian could be very useful in realizing Anton's goals, or am I saying that wrong? Anton, what do you think?
No, absolutely, and very complementary perspectives on how this market is developing. So I would welcome further contact.
Well, that would be all from my side, except to thank everybody for joining and to thank Ian and Anton for your very interesting stories. Ian or Anton, if you have any closing remarks, please go ahead.
Basically, I want to thank you for the opportunity to have shared our excitement about how fintech and energy are really working hand in hand to make energy transition happen. So that's really my closing comment.
All right. Ian, anything from your side?
The one thing I would probably just end on is I do get a number of questions when I have spoken to investors, but other people and businesses particularly, who are worried of if is this going to happen, particularly in light of the recent election result in the US and the macroeconomic climate, in terms of is this just going to get kicked further down the road? Is the market going to kick off as much as everyone hopes, or a lot of people hope it will? And certainly our experience so far is, if your use case and your message is clear enough, it doesn't have to be a regulatory requirement to get business. 90% of the businesses that we work with have no regulatory requirement to report. They're below the sort of thresholds in terms of 40 million euros in the EU and 36 million in the UK. So the market is definitely there and it's growing. Clearly, there are pressures and challenges, as there are with lots of businesses, but there are so many. What we're starting to really see accelerate is the impact of larger businesses being required to report from a regulatory perspective, putting pressure on their supply chains to change. And that's meaning, even if they don't hit the regulatory area, they're still very interested in this space to help differentiate and grow their own businesses in what is an ever more increasing and challenging environment for them as well.
Yeah, I hope that regulation will not be the only stimulus that we need to realize these goals, because I think it's important for all of us. But probably everybody who's in the webinar now agrees with me, because otherwise you probably wouldn't be here. Okay, well, thank you very much for this very interesting hour, and I hope to see all of you back in our fine network. Thank you so much. Bye.